For years, hydrogen has been described as the fuel of the future, the clean molecule that would finally decarbonize industries too carbon dependent to electrify. From steel and fertilizers to shipping and long-duration storage, hydrogen has been positioned as the bridge to a zero-carbon economy. But beneath the excitement, beneath the government strategies and gigawatt-scale announcements, the hydrogen sector is facing a reality that few want to discuss openly. Hydrogen has a profit problem. The economics are not where they need to be. The business models that worked on paper in 2019 are struggling under real-world conditions in 2025. Manufacturers are changing course. Developers are rewriting project plans. Investors are demanding clearer paths to returns. And governments are shifting incentives to make the economics work. The hydrogen industry is not collapsing, it is evolving. But the evolution is painful, necessary, and reshaping the sector more dramatically than many realize. The profit problem begins with the core fact that green hydrogen is expensive to produce compared to existing fossil-based alternatives. Nearly 95% of global hydrogen today is produced from natural gas through steam methane reforming, a method that emits substantial carbon dioxide but costs very little. Green hydrogen, produced through electrolysis powered by renewable electricity, requires vast quantities of low-cost, clean power, water, advanced electrolyzers, storage, compression, and transport infrastructure. Each of these components carries a price tag. When combined, the levelized cost of hydrogen often exceeds what industries currently pay. While optimistic projections point to sub-$2 per kilowatt hydrogen in the near future, many real-world projects still sit in the $4 to $7 per kilowatt zone, depending on region, power costs, and system efficiency. The gap between aspirational economics and actual project economics is the first reason business models are being rewritten. Electricity costs dominate the economics of hydrogen, often representing 60 to 80% of production cost. Many early hydrogen projects assumed extremely low electricity prices based on idealized renewable curves. But when developers moved from feasibility slides to real procurement, reality hit. Solar and wind prices fluctuate. Curtailment does not always align with electrolyzer availability. Grid electricity prices vary by hour, season, and region. And renewable build-outs have faced delays due to interconnection queues, land constraints, and commodity price volatility. Suddenly, many early project models based on constant low-cost electricity became unrealistic. Developers quickly discovered that hydrogen economics are not driven by nameplate electrolyzer efficiency alone. They are driven by capacity factor, electricity cost structure, and operational strategy. This forced a shift in business models from pure renewable coupled hydrogen to hybrid models mixing renewables, grid power, and sometimes even off-peak tariffs or corporate PPAs. The second part of the profit problem comes from electrolyzer costs and performance. As gigafactories expand, electrolyzer prices are dropping, but not uniformly or as fast as early forecasts suggested. Stack degradation rates vary widely by manufacturer and technology type. Some units need more maintenance than expected. Others operate efficiently only under narrow load conditions. Replacement schedules are more frequent than anticipated in a few deployments, affecting lifetime cost assumptions. Early industry projections assumed linear cost declines without considering supply chain constraints, critical mineral availability, or quality assurance challenges in rapid scale-up phases. This mismatch between anticipated and real electrolyzer performance has pushed many companies to reconsider procurement strategies, contract structures, and long-term maintenance models. Some developers have adopted electrolyzer as a service contracts, shifting CapEx toward OpEx. Others negotiate long-term performance guarantees with penalties involving availability targets. The business model is shifting from selling equipment to selling uptime because project bankability now depends on operational certainty, not just hardware delivery. A third challenge stems from infrastructure. Hydrogen is not like electricity, which travels easily through wires. It must be compressed, stored, and transported. Pipelines require new materials or retrofitting. Ammonia or methanol production requires additional equipment. Export strategies rely on port infrastructure. In many regions, this supporting ecosystem does not yet exist. Developers cannot simply build an electrolyzer plant and expect industry to take the hydrogen. Industrial clusters with off-takers exist, but not everywhere. Without firm long-term offtake agreements, no bank or investor will fund a large-scale hydrogen project. The mismatch between supply ambition and offtake maturity has resulted in many projects being delayed or paused. As a result, companies are rewriting business models away from pure merchant hydrogen sales toward integrated solutions where developers co-locate hydrogen with industrial consumers or partner directly with steel, ammonia, or refining companies. Co-location reduces transport costs and increases offtake confidence, improving profitability. The new model is not build hydrogen and find buyers later. It is secure buyers first and build hydrogen around them. Another factor influencing hydrogen's profitability is the emergence of new competitors and shifting technology narratives. In some regions, direct electrification through heat pumps, electric furnaces, or direct reduced iron using electricity competes directly with hydrogen solutions. Batteries increasingly handle short-duration storage that some hydrogen projects originally targeted. Advanced nuclear technologies, if they come online, could supply cheaper heat and electricity, changing the economics of some hydrogen-intensive industries. Additionally, blue hydrogen, produced from natural gas with carbon capture, has made significant progress in capture rates, operational efficiency, and commercial acceptance. In markets like the United States, where natural gas is cheap, blue hydrogen currently has a cost advantage over green hydrogen. This has forced green hydrogen developers to refine their value propositions. They emphasize long-term cost declines, carbon intensity advantages, policy incentives, and energy security benefits rather than competing purely on price. It is a strategic pivot toward market positioning rather than cost parity alone. Governments have also played a major role in reshaping hydrogen business models. The United States Inflation Reduction Act introduced production tax credits for low-carbon hydrogen that are generous enough to fundamentally alter project economics. These incentives have made some green hydrogen immediately competitive, attracting rapid investment and spurring gigafactory construction. By contrast, Europe's regulatory landscape has been slower and more complex, with strict rules on temporal matching between renewable power and electrolyzer operation. These regulatory burdens complicate project modeling. Developers in Europe must either redesign operations to comply with hour-by-hour matching or seek exemptions. Meanwhile, China's hydrogen expansion is driven less by policy incentives and more by industrial strategy, low-cost manufacturing, and aggressive scaling. These regional differences force companies to adapt business models to local policy, incentive structures, and energy market realities. As a result, global hydrogen companies no longer operate with a single strategy. They operate with regionally tailored strategies. Investors have also changed their expectations. In 2020 and 2021, hydrogen was positioned as a growth story, attracting speculative capital. Many companies went public through SPACs and their valuations soared despite limited revenue. Today, the psychology has shifted. Investors want revenue, not projections. They want offtake agreements before plant construction. They want to see operational data, stacked durability numbers, and maintenance records. They expect realistic financial models with sensitivity analysis on electricity price, CapEx, and utilization. Unrealistic early-stage pitches no longer attract money. This shift in investor expectations has forced hydrogen companies to redesign their financial models. Some now adopt phased development plans to reduce CapEx risk. Others partner with utilities or oil majors to improve credibility and share infrastructure. The era of speculative hydrogen investment is over. The era of disciplined, data-driven investment has begun. One of the most dramatic strategic pivots happening in the hydrogen sector is the shift from vertical integration to technology specialization. Several companies that once aimed to control the entire hydrogen value chain, manufacturing electrolyzers, building plants, running production, and selling hydrogen, have discovered that such models create risk, dilute focus, and drain capital. The economics simply do not support full-stack vertical integration for most firms. This has led to a strategic pivot. Electrolyzer manufacturers are becoming pure technology providers rather than project owners. Developers are focusing on infrastructure and integration rather than equipment manufacturing. Industrial players are becoming anchor off-takers rather than venture-style investors. The entire hydrogen ecosystem is reorganizing around specialization, partnerships, and clearer role definitions. Companies that adapt quickly will survive. Those that cling to old models risk being outcompeted. Another critical factor is the rise of hybrid power hydrogen models. Early visions assumed that green hydrogen plants would rely exclusively on renewables, but real-world economics revealed that pure renewable coupling can result in low capacity factors that make the electrolyzer capex too expensive on a per-kilogram basis. Developers are now combining solar, wind, grid power, batteries, and sometimes even curtailed hydro or geothermal to optimize operations. These hybrid strategies maximize electrolyzer utilization while keeping electricity costs manageable. The business model is shifting from pure green hydrogen to operational hybridization, where green hydrogen remains the aspirational target, but economics drive blended operations. This hybrid model significantly improves profitability, reduces risk, and enables flexible participation in energy markets. Water availability is another challenge often underestimated in early hydrogen business plans. Electrolyzers require purified water, and large hydrogen plants need millions of liters per day. In water-scarce regions, this means desalination or industrial water recycling. Both options introduce additional capex and operational costs. Once again, developers are adjusting business models, co-locating plants near industrial wastewater sources, using seawater desalination, or partnering with municipal utilities. The economics of water are becoming a core part of hydrogen profitability strategies, especially in the Middle East, India, Chile, and parts of the United States. As hydrogen companies confront these realities, new business models are emerging. One promising model is hydrogen as a service, where developers build integrated systems and sell hydrogen based on long-term contracts at guaranteed prices. Another model involves co-production, where hydrogen plants also sell oxygen, heat, or other byproducts to improve revenue streams. Some companies are pursuing modular hydrogen hubs that can scale incrementally based on offtake demand. Others are building vertically integrated ammonia or methanol plants to convert hydrogen into easier-to-transport molecules. These diversified revenue strategies are becoming essential, as pure hydrogen sales alone often cannot justify early-stage project economics. The biggest strategic shift, however, is the realization that the hydrogen industry is not competing against fossil fuels alone. It is competing against uncertainty. Developers must convince investors, regulators, industries, and utilities that hydrogen projects can deliver reliable output at predictable cost for decades. This requires new types of contracts, new financing structures, and new partnerships between developers, OEMs, and industrial customers. Banks want to see a stable supply of electricity, a proven electrolyzer vendor, strong offtake agreements, clear operating models, and strong risk mitigation. Business models are being rewritten not because hydrogen is failing, but because the sector is maturing. The early hype cycle is over. What comes next is disciplined execution. Despite the challenges, the momentum behind hydrogen remains strong. Governments continue to support it, industries continue to demand it, manufacturers continue to scale electrolyzer gigafactories, project developers continue to refine cost structures and operational strategies. Hydrogen is not going away, but profitability is no longer assumed. It must be engineered. It must be earned. And it requires business models that reflect real-world complexity rather than conference-stage optimism. Hydrogen's profit problem is not a crisis. It is a correction. It is the industry transitioning from idealism to pragmatism, from aspiration to execution, from projections to practice. The companies that rewrite their business models for this new reality will lead the sector. Those that don't will fade. For developers, consultants, investors, and policymakers, understanding this shift is essential. The hydrogen landscape is being rewritten in real time, and the next decade will determine which companies define the future of clean hydrogen and which ones become footnotes in its early history.